Hello friends, welcome to the first video on the series of securities laws videos which I'm going to host in a period of time, which is in regard to the Securities Contract Regulation Act 1956, part 1. I would like to highlight it as part 1 because initially I thought I would like cover the entire act in a single video, but later I realized that the basics of the Securities Contract Regulation Act should be taught in a manner which would give you more time to understand and digest various technical terminologies used in this particular act. So with keeping that in mind, I designed this particular part 1 to only cover the basics under this particular act. So if you look at this slide, so we are going to cover only three things in this particular module, or you can say in this particular part 1 or in this video, which are the object of the act, the stock exchanges, the concept of the stock exchanges, and the clearing corporation. So it may sound weird, these are terms which you have already heard or something, but to be frank, many of the students miss out on these basic concepts. So I wanted to contribute more time on these basic concepts to understand how to look at the object of an act and what is the importance of object of an act. What is the role of stock exchanges in the securities market, the history of the stock exchanges, how did it evolve to the current existing environment of stock exchanges, and the concept of a clearing corporation. So I guess many of amid the fresh the ones who would have read the securities laws, or the students who are first time listening to the securities laws concept would have some doubts, or maybe somewhat not that comfortable with this term clearing corporation, right? So I've taken a bit of time in this particular video to explain the concept of clearing corporation as well. So I hope you will have a clear understanding of this concepts, of the basic concepts of the Securities Contract Regulation Act 1956. How the laws are there in respect of the securities market in India. So if you can observe here on your left, you can find out that there are various acts, rules, regulations. So what are they? So basically we are looking at the legal framework in the securities and capital markets in India. So first thing you should remember is that in the securities market, so when I use the word securities, I'm referring to not just the equity shares, but to many other things which we would discuss in part 2 of our discussion. So just for now, remember that securities includes shares. It need not necessarily be only shares. It includes shares, even bonds, stocks, debt instruments, all come under the ambit of the word securities. So securities has a broader meaning than any other term. So to move further, let us understand that securities market, or you can say the securities, the ambit of securities is totally within the purview of SEBI, which is the Securities Exchange Board of India. But the act which we are referring to is SCRA, which is in the year 1956. But if you can observe from the act here, SEBI has established in the year 1992. So what happened during this year, and what led to SEBI being in force, or SEBI being given the power as a regulatory in the securities market? So before SEBI coming into picture, the central government, that is the Ministry of Finance, had the entire power over the securities market in the country. So what went wrong? As a ministry, it had various other duties and obligations to perform. And one such obligation was the securities market. But later, a need was felt when there is a scam from a person like Harshad Mehta, which had shook the entire securities market of the country. That was when the government realized that there needs to be a independent regulatory authority which would look after the provisions, or which would look after the compliances and other regulatory environment in the securities market in the country. That is when the Securities Exchange Board of India Act 1992 had been enacted. So after Securities Exchange Board of, let's say SEBI Act had been enacted, the need was felt now to electronically deal in the securities rather than in the paper mode, right? So previously there used to be person A, person B, they deal in a security which used to be in a documentary form. So he signed the document, B signs the document, and it used to be a contract, right? Similarly, the contract is nothing but again here a securities contract. That's why the name of the act, Securities Contracts Act, correct? So when A entered into a contract with B to sell a particular security, let us say shares, and B agreed to buy certain securities, they both entered into a contract and they signed off. Now government thought whenever there is a physical document involved, that lot of the kind of mechanism to be put in place, the kind of controls and checks to be put in place had been very delicate, and it is like very wider and broad. Then the government thought, no, it's not fit to have such kind of environment in a growing market, because the basic idea of government is to get in more money of the savings of the public into the corporate world. And how is that possible? That is very much possible through the securities market. So with this object in mind, SEBI had enacted, or sorry, rather the government of India had enacted the Depositories Act 1996. So what is the role of the Depositories Act? The Depositories Act is nothing but it ensures that the shares are traded in electronic form, or more popularly called as the demat form. In the later series of videos on the securities market, we will understand and analyze what these depositories are and what is the concept of dematerialization. Now, keeping all this aside, let us try to analyze what is the legal framework or the basic thing which everyone as a student needs to remember or understand in terms of a securities market. The first thing, as we already discussed, to be understood is there is one regulator and only one regulator in the securities market, which is the Securities and Exchange Board of India. So why a regulator? You understood the reason, right? The reason is you need someone who has to be, there has to be a dedicated regulatory body which deals with or which monitors day in, day out the regulatory market in terms of the securities market in India. So now let us understand the various lawmaking mechanisms, or you can say the legal framework which is exercised by SEBI. So basically there are three particular acts which are concerned with the securities market in the India, or you can say the capital market in the India. These are Securities Contract Regulation Act 1956, Securities and Exchange Board of India Act 1992, and the Depositories Act 1996. So these three acts majorly govern the capital markets in the India, or capital markets, that to the securities market in India. So under the Securities Contract Regulation Act, there are certain rules and regulations, and similarly under Depositories Act, there are certain rules and regulations, basically regulations. So what are these rules and regulations? For that, let us try to take certain basic understanding of the same. So the Parliament of India passes something called as an act. So there is a bill which is introduced in the parliament, and that bill, after being approved by the parliament and accepted to by the president, it would be transformed into an act. This act can provide for something called as delegated legislation. So it's nothing but delegating the power to legislate on certain areas to another authority. So through the Securities Contract Regulation Act, through the SEBI Act, and through the Depositories Act, the central government had delegated its powers to SEBI to make various regulations. Because it is a regulator, it can make various regulations. Then what is the concept of rules? So rules are something which are within the purview of the central government. So there are two things here. The act is delegating its powers, one to the central government to make rules, and two to the SEBI to make regulations. So the power to make rules lies with the central government, and the power to make regulations lies with the regulator, and in our case that regulator is none other than SEBI, right? So to quickly summarize this particular concept, Any power to make rules or to make regulations shall flow from the act, and this cannot be implied, or it cannot, it basically shall be prescribed expressively in the act. That is the major condition which one should remember, right? So just to quickly summarize, power to make rules has been delegated to the central government, and power to make regulations had been delegated to the SEBI. So from the word regulation, you can understand that it is nothing but a regulator. So regulator powers have been related to SEBI, and making rules. Rules are something which are always beyond the powers, hence it is preserved with the central government. And all of this has been provided under the Act. So every act provides for that. The SCRA Act provides for that. The Securities Section Board of India Act provides for that, and the Depositors Act provides for that. So during our web series, or during the series of videos on the capital markets, we would look into the SCRA, SEBI and Depositor Act in detail. And since our discussion today or in this video is basically pertaining to the Securities Contract Regulation Act, let us look into what this particular act is all about. So let us try to decipher the meaning of the act, right? So it says Securities Contracts, and within brackets Regulation Act. Leaving behind the year, let us try to decipher this. There are three words here: securities, contracts and regulation. So we can simply say that it is an act to regulate contracts dealing in securities, which is nothing but there is a contract where there are various parties, and the subject matter of the contract is security. So where the subject matter of a contract is a security, and such contract is entered into between two parties A and B, this particular contract would come within the ambit of Securities Contract Regulation Act. Now, why do we have to regulate such contracts? Because these contracts are majorly dealing in money. So when it is dealing in money, and that too that money which would impact the economy of a country, and that is when you need a proper regulation dealing in regulating such kind of transactions. And hence the Securities Contract Regulation Act 1956. I hope this is making some sense as to have a separate act to regulate certain contracts. Now if you can observe from below, there are various circulars, master circulars, general orders, guidelines, rules, regulations issued by the SEBI. So what are all these? What are they? So they are basically the legal framework provided by SEBI for the securities market. So if you wish to enter into securities market as a practitioner, maybe a CA, as a practicing CA, practicing CS or practicing CWA, who wishes to practice in the securities market, they have to be thorough with all these which are being prescribed by the SEBI and which are available on the SEBI website. The link to the SEBI website is available in the description below the video. So if you can quickly go through, there are various regulations which have been prescribed by the SEBI, right? And all these regulations we would skim through in our series on the securities laws market. However, this is basically an introduction to the securities market, and hence I had to take some time to let you understand what is happening in a securities market. So unlike in a money market where RBI is the regulator and where Ministry of Finance is keenly observing what is happening, in a securities market, SEBI is the regulator, and even though the Ministry of Finance is observing what is happening, but SEBI had gone a way ahead in ensuring that the investors' interest is protected. The basic concern why SEBI is so proactive is investors are putting in their saved funds, the money which they save, the savings which otherwise would have been lying untouched in a bank account, they are putting in a securities market to have more returns on their investments. Hence, SEBI wanted to provide a market where it is not controlled in a few hands, but it is generic and it provides scope for people making profits out of their investments, right? So with all this brief intro, let us look into the major aspects of the Securities Contract Regulation Act 1956. Before we jump into various provisions under the Securities Contract Regulation Act, let us firstly understand the object of the Act. And here, let me suggest you something. Whenever you are referring to any law, not just the Securities Contract Act, for that matter, any other act, first thing as a student you have to ensure is to look at the preamble of the act. And that is what I have reproduced here on this slide. So the preamble of the Act says that the Securities Contract Regulation Act is an act to prevent undesirable transactions in securities. So the object of the Act is to prevent undesirable transactions in securities. So that is the reason why it is Securities Contract Regulation Act. It is not prohibiting people from entering into contracts dealing with securities, but it is only to regulate such contracts with an object to prevent undesirable transactions in securities. But how can it do? How can it basically prevent undesirable transactions in securities? That is by regulating the business of dealing therein. So whatever is the business which the parties have in terms of securities, or which the parties enter into for dealing in certain securities, that has to be regulated. And when that is regulated, that is when you can ensure that there is certain control or checks or measures on the transactions in the securities by various parties. But here, if you can highlight this particular term, which is undesirable. So it is not talking about all the transactions, but undesirable transactions. But can we simply on the face of it say whether a transaction is desirable or not? Right? It is next to impossible. So that is the reason why the Act said that, yeah, it can be decided undesirable or not at a later point of time, but initially all the transactions will be under the purview of the Securities Contract Regulation Act. And the other part of the preamble is to provide for certain other matters connected therewith, which usually would be found in any preamble for that matter under any other act, right? So to summarize, the object of the act is to ensure or is to prevent undesirable transactions in securities by people in the securities market. And how does it ensure that? It ensures it through regulating such dealings, regulating such businesses which are indulged in dealing in securities. Now, I think many of you might have focused on this particular usage or phrase which has been struck off by me, which is nothing but prohibition of options. So why did the preamble, or you can say, why did I basically strike off this particular phrase? So this phrase, the striking of this phrase is intended to reflect the amendment made in the act at a later point of time. So why did this amendment come? Why did they amend the preamble to say or to delete the words prohibiting options? So options is nothing but options is something which comes within the concept of derivatives. So derivatives at that particular point of time were treated as something which is very speculative in nature, and hence they wanted it to be prohibited. So the basic pretext, or you can say the basic funda of derivatives, has been prohibited through this particular act at when it was initiated or when it was enacted in the year 1956 and enforced in the year 1957. However, later when they realized that derivatives is also a different market and it has to be regulated rather than being prohibited, then they have removed this usage of phrase from this particular preamble, right? So let us go further in terms of the Securities Contract Regulation Act. The Act, even though was enacted in 1956, it came into force from 20th February 1957. So under the Act, SEBI after 1992, as discussed earlier, has become the regulator. But basically this Act gives the following powers to the central government, which are firstly regulatory jurisdiction over the stock exchanges, regulatory jurisdiction over contracts in the securities, and regulatory jurisdiction over listing of securities on the stock exchanges. So if to quickly summarize, firstly it ensures recognition and continued supervision on the stock exchanges. Then any contracts in the securities come within the ambit of the Securities Contract Regulation Act, and the listing of such securities on the stock exchanges also would be impacted, and hence this is coming under the ambit of Securities Contract Regulation Act. So as I said earlier, once you understand what is the preamble of any act, the next thing you have to look into is what what this act is all about, and which is a regulator, and what are the various objects or powers under which this act is empowered, right? So with this brief intro into the act, let us look into various technical provisions prescribed under this particular act. Let us start our discussion with the understanding of this institution or the words stock exchanges. Now, before we go into the definition of a stock exchange, let us try to interpret the meaning of the stock exchange through the words. So there are two words used, which is stock and exchange. So there should be some kind of an exchange of stock, correct? So with this approach, now let us look into what is a stock exchange and how is it defined under the Securities Contract Regulation Act. It says any body of individuals, whether incorporated or not, constituted before corporatization and demutualization, right? So there are two words which we need to learn, which is corporatization and demutualization. Let us look into it a bit later, but now let us also look into the other part of the definition, which says any body corporate incorporated under the Companies Act. So there are two sets of possible modes of business of a stock exchange. One, either you can establish a stock exchange through a body of individuals, or two, you can establish a stock exchange through a body corporate incorporated under the Companies Act, either 2013 or 1956. And so does it mean all body corporates or all body of individuals are by default fall within the definition of stock exchanges? No, the definition is not just done there. The definition is continued by saying that such body is for the purpose of assisting, regulating or controlling the business of buying, selling or dealing in securities, right? So this is very important. So basically there is a stock exchange, and the very pretext of the stock exchange, the business of the stock exchange is dealing in securities, and it can be either buying or selling or any other dealings in securities come within the ambit of stock exchanges. So the very important learnings from this particular definition of stock exchange is that there has to be a body of individual or a body corporate, and which should be only for the purpose of assisting or regulating or controlling the business of buying, selling or dealing in securities, right? Now let us try to understand the meaning of the words corporatization and demutualization, and what is the relevance of the same in terms of the Securities Contract Regulation Act. So before I go further into the meaning of demutualization and on corporatization, let me give you a brief history of how this whole concept of the current stock exchanges has come into picture. So before even this information and technology started playing a crucial role in Indian securities market, it was the age-old practice of trading over the counter. It was OTC. It's like, there used to be a closed room where a buyer shouts buy, 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 or sell, 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 and the other party would be like buy, 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 and they approach each other. So let us take example ABC Company Limited shares. Then there would be someone shouting ABC Limited 500 shares, 500 shares, buy, 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 and there would be some other party elsewhere standing who would be looking after someone who is ready to buy ABC Limited shares, and he would be shouting ABC Limited 500 shares, sell, sell, sell. When they both look at each other, and when they both understand that yes, there is someone who is trying to sell, there is someone who is trying to buy, they both meet each other, shake their hands and exchange their securities. The one party pays, the other party gives bonds, and they enter into a contract. That was how over the counter trade used to happen before the information technology had taken its path in the securities market or in the stock exchanges. So at that particular point of time, in order to facilitate such mechanism, a few group of people used to form a body of individuals and then simply start doing this particular activity of dealing in securities of various companies. But do you think that was feasible? Yes, it was feasible at that point of time, but later it was realized that such body of individuals is acting in the benefit of the members who are constituting that body of individuals, but it is not acting in the benefit or in the best interest of the investors who are actually building the business for such body of individuals. And hence, to discourage such activities, SEBI thought it fit that this is not something which is happening. If you want to continue doing your business, you first have to ensure the protection of the investors of the country who are investing in various companies through your organizations, right? And the body of individuals or such stock, the age-old stock exchanges said, yeah, we are doing the same, tell me what else we have to do. So the SEBI Thornos has constituted a committee, and the committee recommended that the first thing this stock exchange just shall do is to corporatize, that is to convert themselves into a corporate. And the second thing they suggested is demutualization, that is to segregate their role into, right? So to segregate basically the ownership and the management. So there are members. So basically in a body of individuals, the only concept was there were members who were constituting such body of individuals. Such body of individuals is usually an association of persons or a society majorly, right? And then there were investors. So SEBI said, boss, I need protection of investors. I don't care what your members are all about, but I want protection of investors because I am the regulator in this market. And the body of individuals said, yes, we are ready to do whatever you want us to do. And SEBI said, firstly, convert your body of individuals into a corporate. So corporatization is nothing but converting a body of individuals or any other organization or any other body into a corporate form of business. That is what is corporatization. So in a corporate form of business, what is the basic funda? Is to have a separate legal entity than that of its members. So corporate form of business is nothing but having a separate legal entity. Then what is the other part, that is demutualization? So demutualization is nothing but segregation of ownership and management. So they do not want the owners to manage. So it's very clear now that SEBI wanted, the owners should not manage because it is amounting to illegal gains from the owners through their trading, right? Which is something not the intention behind having a stock exchange. The intention of having a stock exchange is to provide a fair mechanism of trading in securities of various companies across the country. If you have such kind of practices, that would basically damage the very pretext of having a stock exchange in a country. That is when SEBI had taken this tough choice of corporatization and demutualization of the existing regional stock exchanges in the country. So there were 22 stock exchanges in the country which were treated as recognized, it were treated as the regional stock exchanges in the country. So what were these 22 stock exchanges doing at that particular point of time? So they were catering to the investors of the particular states. Say Hyderabad had its own stock exchange. Bangalore had its own stock exchange, right? So similarly, many parts of the country had their own stock exchanges where the companies of that particular registered office used to list their shares in that particular stock exchange. Then need was felt to have a national platform where people across the country can trade. So if you have a regional stock exchange, the trading is restricted only to that particular region. But now the concept is to expand it and take it on a national platform, and that is when all these regional stock exchanges started failing. The reason is they did not have such capital or such capex to expand themselves into businesses or having nationwide platforms. And after this particular concept of stock exchanges being asked to convert into corporates and asked to be demutualized, then came the concept of recognition of a stock exchange. So in 2003-2004, SEBI said was only when you corporatize and demutualize and also adhere to all other conditions which I prescribe, I would recognize you as a stock exchange. If not, I would not recognize you as a stock exchange. As a consequence of this particular decision taken by the SEBI, the end effect is that there were only two recognized stock exchanges in the entire country, which are the National Stock Exchange and the Bombay Stock Exchange of India, which are still the only two which you can find in India, which have nationwide platform for trading in securities of the companies which are listed its securities on these stock exchanges. The rest 20 or 21 of the regional stock exchanges have stopped their businesses because they were not able to meet the conditions set up by the Securities Exchange Board of India in that regard, right? So I hope you have you got a basic idea of what a stock exchange is. It is very important to, you know, have or to invest more time on understanding the basic idea of what a stock exchange is, because the rest of the entire discussion of the securities market cannot go ahead without this usage of the terms stock exchange. So if you understand the meaning of the word stock exchange, that you're basically like trying to understand the entire context of securities market. So post this recognition scheme or recognition ideology introduced by the SEBI, wherein they amended the Securities Contract Act by inserting section 4A and 4B for corporatization and demutualization. After that, any other company or any other business which wants to form a stock exchange, it has to be only a body corporate. That's why the word constituted before corporatization and demutualization. So a stock exchange is a body of individual if it is before this corporatization demutualization, but effectively this particular part of the definition is redundant. So as of now, if you want to be a stock exchange, you can only be a body corporate incorporated under the Companies Act or under the 56 Act or the 1913 Act, before whatever it is, but it has to be only under the Companies Act. You cannot be any other form of business in order for you to be a stock exchange, which is very clearly communicated by the SEBI. As an extension of our understanding of the stock exchanges, now let us try to understand what is this concept of recognition. So as I told earlier, SEBI said only if you demutualize and decorporatize, and corporatize, and that is nothing but converting yourself as a corporate, I would recognize you as a stock exchange. So all the stock exchanges were asked to make applications in Form A to the SEBI, and such application should also be accompanied by the bylaws of, so there's a spelling mistake, it's bylaws. So bylaws for the regulation and control of contracts, that is the securities contract. So how do you control such securities contracts? You have to come up with your bylaws and also your rule book, which will talk about the governing body. So just like board of directors of a company, a stock exchange has a governing body, office bearers, and admission of members. So admission of members is nothing but the ones who would have the shareholding in the stock exchange. Office bearers is the ones who would have the management of the stock exchange, and the governing body is something which would look after the entire control of the stock exchange. So they wanted strict rules in terms of these three institutions. So thankfully, fortunately, in order for the students not to have more burden, there was no recognition of stock exchange post 2013-14, right? The only stock exchanges which were available or which were recognized by the stock exchanges by the SEBI are NSE and BSE, and till date there is no other stock exchange which has come into force for the securities. That is basically, I'm here referring to only the equity shares, listing of equity shares. Of course there is this MS exchange which has been, which is under thoda like it is still there but not yet completely there in this business. It is into a different segment of the securities market. And you had commodities market also. The commodities also market is also provided by the NSE and BSE, because that is a very different discussion. We will slowly, when we go ahead in the securities market, I will slowly introduce you to the other exchange which is there in the country, which deals with a different segment of the securities market. But for now, remember that there are only two exchanges, which are NSE and BSE, which deal with securities, that is nothing but equity shares which are being listed or other debt securities in the country, right? So with this brief discussion, let us go a step further to understand other concepts under the Securities Contract Regulation Act. Now that you understood the concept of recognition of a stock exchange, now is the time to explain the concept of withdrawal of such recognition. So once you are recognized to act as a stock exchange, it is not the end of the story. You are still being monitored by the regulator. But and where the regulator thinks, boss, there is something fishy, right? In the interest of trade or in the public interest, I don't think so. This company is going ahead in this particular interest. Then the regulator can, by way of a written notice, to the stock exchange, demand for explanation as to why I should not withdraw the recognition given to you. Right? So basically, as a principle of natural justice, I give you an opportunity of being heard. And where after giving you an opportunity of being heard, the SEBI thinks that, no, this is something not, this stock exchange is not acting in the interest of the trade or in the public interest, then the SEBI would simply notify in the official gazette that so and so stock exchange is hereby, the recognition given to so and so stock exchange is hereby withdrawn, and hence that is the end of the story. So all the stock exchanges have to ensure that they are acting well within the purview of the rules and regulations prescribed by the SEBI, right? So this is one aspect for those stock exchanges which are continuing, or which are continued to be in the business of being a stock exchange. The other way by which a stock exchange or a SEBI can withdraw the recognition of a stock exchange is through an automatic withdrawal route. So what is this automatic withdrawal route? It is again redundant now. So where there is a body of individual which has been incorporated or not incorporated, and before 2003, when there was no corporation demutualization, which did not meet with the conditions prescribed by the SEBI, which did not corporatize, that is, which did not convert into a corporate form of business, and which did not demutualize, that is, which did not segregate the role of the ownership and the management, then that amounted to a automatic withdrawal. And it basically is the language of the act basically says that where you do not meet the conditions of corporatization and demutualization and other conditions prescribed by the SEBI for recognition of a stock exchange, then such stock exchange, or you can say the recognition given to such stock exchange, shall stand withdrawn. Right? You're getting the point. So to summarize this, there are only two ways by which you can withdraw the recognition given to a stock exchange. One, where SEBI feels that in the interest of trade or in the public interest, such recognition has to be withdrawn, and two, through automatic withdrawal route. In the first instance, SEBI has to give an opportunity of being heard to the other party, send them a notice, listen to them, and then pass an order by notification in the official gazette. But in the second instance, there is no such requirement. When you do not meet and you do not come up to the SEBI by filing Form A, or even by filing Form A by not filing the required documents or by not complying with the required conditions, then it is deemed to be a withdrawal. Before I take you through the legal context of a clearing corporation, let me try to analyze, or let me try to explain the meaning of a clearing corporation. So again, the word, or you can see the combination of words, gives you a lot of context and the meaning which is ascribed to under the legal jargon, right? So to your right is a block wherein I would be explaining you the concept of a clearing corporation. So here the term B stands for buyer and S stands for seller. So here there is a security and S is selling such security to B, correct? Now, how can he sell such a security to B? He can sell such a security to B, and B can buy such a security from S through a institution called as stock exchange. Agreed? Yes. So what is stock exchange doing here? The role of the stock exchange is to exchange the security of S to B, in return of which B gives payment, that is money. So effectively, stock exchange is exchanging security for money, right? Is that clear? Good. However, if you look at the structure of a stock exchange, there would be multiple companies listed, multiple buyers, multiple sellers, right? And
at a real-time basis, you have to capture all these deals. So stock exchange can help you in entering into a contract, but exchanging the security and also the payment needs a regulated, or you can say a consistent or a different authority which would ensure that timely payments are made and timely delivery of security is also being made. And that is when the lawmakers thought the concept of a clearing corporation. So the word clearing, it will clear the trade. So for again the same context, there is a buyer and there is a seller. The buyer wants to buy, the seller wants to sell, and they met in a stock exchange, right? Of course, I'll later explain you how the electronic form of stock exchange actually works. There, I will host a separate video on the functioning of a stock exchange and a clearing corporation for better understanding. So here, again, coming back to the example, B and S are two different people from two different places. They don't know each other. The very context of a stock exchange is that the buyer doesn't know the seller doesn't know the buyer, and they're selling the shares. And when a buyer is ready to buy the shares, he needs certain funds in his account. And when a seller is ready to sell the shares, he needs certain shares in his account. So when seller is selling the shares and buyer is ready to buy the particular shares, just imagine a situation when either seller does not have the shares or buyer does not have money in his account. Will there be a contract? No. So when I say contract, you have to go to the basic context of the Indian Contracts Act 1872. What does it say? For any contract, there has to be offer, acceptance, and consideration. So there is offer from B to buy, from S to sell. There is acceptance from B to buy, yes to sell. Yes, there is an offer, there is an acceptance, agreed. But what about the consideration? And such consideration shall be complete, right, and adequate and complete. So here the consideration for B is the shares, the consideration for seller is the money, the payment, right? So security is consideration for B, payment is consideration for S. Now there should be someone who has to ensure that such consideration is full so that there is a securities contract, and such corporation or such body which clears these kind of a contracts is nothing but a clearing corporation, right? So now to quickly summarize and to better understand this example, let me introduce you the role of a clearing corporation. So firstly, there is a stock exchange. B wants to sell, let us say, sorry, B wants to buy 500 shares of ABC Limited. S has 500 shares. On the stock exchange, the market price is rupees 10 per share. B in his account has 5,000 rupees, right? Now B on the stock exchange platform, he said, I am ready to buy 500 shares, and S said, I am ready to sell 500 shares, and immediately the electronic system in the stock exchange triggers and it gives a notice to the clearing corporation. Then the clearing corporation will look into whether B has the 5,000 rupees or not, and also whether S has 500 shares or not. And in a period of 2 days, the clearing corporation will take this money from B. So this 5,000 from B will go to the clearing corporation, and these shares of 500 will also go to the clearing corporation, right? Getting the point? Let me just make it very, like, thoda sa clear. I hope there are too many arrows and all, that would be more confusing, I guess. So this rupees 5,000 in the B's account will go to the to the clearing corporation, and these 500 shares of S also will go to the clearing corporation. So the payment is also going to the clearing corporation. The delivery of shares is also, or you can say the shares is also going to the clearing corporation. Now what will the clearing corporation do? The clearing corporation will send these shares, or rather deliver these shares to B, and the payment received by the clearing corporation will be made to S, right? So here, if you see, the role of the clearing corporation is basically to settle the contracts. And can I do all this on a single day? Of course, if it's a single simple transaction like this, yes, it can do. But here, try to take the bigger picture into your mind. This clearing corporation is acting as a clearing corporation of stock exchange, where there are thousands and thousands, or at times lakhs of trades of shares happening on a single day. So can I do it on a real-time basis? Again, the answer is no. So on a real-time basis, what will happen is only freezing of your contract, which has happened at the stock exchange level. The moment the contract is freezed after the end of the day, there is this concept called T plus 2. T is nothing but transaction day. So on the day of transaction, plus 2 other days, the clearing corporation will take to clear all the contracts. So that is why it is called as a periodical settlement of contracts. Correct? So there is a securities contract and I would settle it on a periodical basis. And how am I settling it? By way of delivery of security and payment for securities. So I basically give the payment to the buyer, to the seller, and deliver the shares to the buyer. So this duty or this function of clearing has been transferred from the stock exchange to a clearing corporation, and that will happen only with the prior approval of the SEBI. Right? Hope I'm making some sense here, right? So there is a buyer, there is a seller. Buyer has money in his bank account, seller has shares. So both of them on the stock exchanges at the simultaneous real-time basis said, once one party, that is the buyer, said I would buy, the seller said I would sell. So stock exchange has freezed the contract. Now the seller has these many shares and these shares are basically freezed from the seller's account, and this money is freezed in the buyer's account, and this money would be transferred to the clearing corporation. These shares also would be transferred to the clearing corporation, and the clearing corporation will exchange these two. It will basically deliver the shares to the buyer and make the payment to the seller in a time period which is T plus 2, that is transaction day plus 2 days, right? And this basically is the duty or a function of the stock exchange itself. However, with too many transactions happening on a single day, it would become impossible for the stock exchange to also take care of this clearing. That is the reason why the stock exchange, with the prior approval of the SEBI, can transfer, or it has to transfer all these duties and functions of a clearing house, that is clearing a particular transaction, to a separate organization, or you can say a separate company, which is nothing but a clearing corporation, and that can happen only with the prior approval of the SEBI, right? And such clearing corporation will have its own bylaws and all with the approval of the SEBI. So this is the basic concept of a clearing corporation, right? So with this, let us try to conclude here the concepts of stock exchange and clearing corporation. Once you are thorough with this basic understanding of the securities market, stock exchanges and the clearing corporation, only then you will understand rest other provisions under this particular Securities Contract Regulation Act. So the part 2 will continue from this slide. So the rest of the slides will be dealt with under part 2 of the Securities Contract Regulation Act.
To help us develop a content, we are very welcome with your feedback. So whatever be the feedback, be it negative or positive, we would definitely take it into consideration and try to improvise our future videos. So you can do it by way of leaving a comment below this video. So in the comment block, just leave whatever be your comment. And finally, subscribe to our channel, Virtual Law.